Hi, my name is Kathleen Vaughn, and today I'll be discussing how central banks affect our economy. Have you ever wondered why interest rates go up or down? Today I'll explain how central banks drive these changes and why it matters to you and me. First, central banks are institutions that manage a country's currency, money supply, and interest rates. Examples include the Federal Reserve, which is in the US, the European Central Bank, also known as the ECB, and the Bank of England. I'll cover how central banks set monetary policy, influence inflation, and stabilize the financial system. When we talk about rates in the central bank compared to 2022 to 2023, for the Federal Reserve, in 2022, the interest rate was 1.75%, whereas in 2023, just 1 year later, it shot up to 4.5%. Whereas the ECB, their rate in 2022 was 0%, and 1 year later, it rose to 2.75%. The Bank of England had a 2022 rate of 0.25%, which shot up 1 year later to 3.5%. Looking at these numbers, you can see how these rates change to combat inflation. An interesting tool that's used is the Taylor rule. They use the target interest rate as well as the equilibrium real interest rate involved with the current inflation rate and the output gap. And that is a formula that they use to systematically adjust rates. When the Fed raises rates, borrowing costs on mortgages and credit cards also rise, which can reduce consumer spending. These types of things involve inflation on grocery bills, savings accounts, just how our money is spent. And even anyone who's gone to the grocery store over the last year can attest to the changes in the spending for the same amount of items. Businesses, on the other hand, highest interest rates increase the cost of loans, and that influences business investment decisions. As far as the government, central banks' actions can impact the government bond yields and thus affect national debt servicing costs. In my experience last year, I was deciding whether or not I was going to trade in my car that I've had for 3 years now. And I noticed the loan interest rate had shot up dramatically. And that was partially due to the central bank raising its benchmark rate to fight inflation, which at the time didn't make sense to me on a personal level because my payment would have been lower for trading in my car. However, the interest rate over time, I would have paid double the amount of what the car was worth. But on another note, I did also see that my savings account interest rate improved, which was a small silver lining. There's a news article on how the Federal Reserve, or ECB, recently increased interest rates to combat higher than expected inflation. For instance, according to a Wall Street Journal report in January of 2025, the Fed raised rates by 0.25% in response to persistent inflation. Emerging markets respond to Fed rate hikes, like capital outflows, currency fluctuations, all of these things are related and interconnected to how the Fed systematically changes their rates. Central banks also injected liquidity to maintain financial stability during recent crises, things like the 2020 pandemic, or any other type of market disruptions. Central banks increasingly use AI and machine learning models to analyze massive data sets like credit card transactions and social media sentiment to predict economic trends more accurately. Tools like advanced economic simulators help policymakers test the impact of possible interest rate changes before implementing them. AI-driven stress tests can quickly highlight potential risks in the banking sector, helping central banks act preemptively. Now, why does this matter? The decisions made by central banks impact our daily lives, from the cost of our loans to the stability of the economy. With AI evolving, will central banks rely more on algorithms than human intuition for monetary policy in the future?